Greg, welcome. I want to go through, before we get to your safety picks, which are obviously intrinsic to the value of this, segment, you see a couple of things that concern you. One, consumer demand has been sustained by fiscal policy. There's been a lot of cash flooding into the market, also monetary. But number two, concerned about slowing corporate earnings. That seems to be happening. But number three, you say you are concerned about asset values compressing or collapsing as debt continues to be incredibly high. One way or another, lots of financial and market crises all come back to one thing, and that is debt, and we've got a lot of it.
Yeah, that's right. And this is typically referred to as a Minsky moment, right? Where the banks, albeit all too late, realized that the underwriting standards were probably a bit looser than they should have been. Right now, from a global GDP standpoint, we're at about 350% debt to GDP, which is about 50%, actually 30% above where we were before the last crash in 2009. So it is something that I'm monitoring, although not raising a five-alarm fire about it at this moment. But your prior 2 points were exactly right. We're going to see top-line pressure for certain companies and sectors over the next few months as demand may deteriorate in certain pockets when we transition from a physical stimulated demand to a labor and wage earning stimulated demand. And so I'm concerned that we'll see some pockets of weakness as we make that transition. I'm concerned on the bottom line that inflation will stay hot, particularly with the port closures and disruptions that we're seeing across the globe, particularly with the problem areas we're seeing in trucking and shipping. And so I suspect that to stay hot until April. So companies will have top line and bottom line challenges. But there are a set of companies that are unique in that they have more insulation, if you will, against those challenges. And so when you look at healthcare and utilities, they are largely immune to whether we have physical stimulus or labor wage earnings. Demand is not effective, and they have the pricing power to protect margins. Banks is another name, highly correlated with a recovery. We see that the net interest margin environment is improving, so I suspect them to be a beneficiary. And surprisingly, tech. Let's see if Microsoft is going to show us another 46% operating margin and 27% growth. Let's see if Adobe's going to show us that type of growth and margin expansion. We saw that at Google. I think if they do, we'll see a bifurcation in the tech trade.
Then let's go straight to what you call some safety areas where I might be insulated against declines. I might even make some money. Some are in value, and they are mostly ETFs. Others, you would say, are more traditionally thought of as growths. A couple of them are in transports. A couple are in tech. Take me through first the value picks, and then we'll turn to the growth side.
Well, I don't know if it's traditional value. I was kind of squinting my eye in order to say that. But for example, when you look at the Vanguard Consumer Staples Index Fund, typically that trades at a slight premium to the S&P. And right now it's trading at 20 times versus the S&P's roughly 21 times. And so I'm not sure that we are yet going to get something that is truly value. I suspect we'll get it in the next couple of months, as if, in fact, we see some of the multiples in large cap tech compress. We'll see it. I think in some of the service and travel and leisure stocks, we're going to see multiples compress over the next months. And so I think we'll have to wait for what we would identify as true value. Right now, I'm more looking for safety. And again, that harkens back to companies that will have a defensible response to any softness we see in consumer demand, i.e. have pricing power, i.e. be enjoying a secular tailwind like anything levered to enterprise software, cloud, or data centers is right now. And on the bottom line, they have, again, that pricing power or just aren't exposed to the areas of acute inflationary pressures that we won't have margin disappointments. And so the names for me there in tech land are Microsoft, Adobe, Google, which all demonstrated spectacular margin expansion throughout 2021. And this quarter is going to be really important. Can they do that again? Can they keep that top line growth of 30% plus with giving us margin expansion as well? That'll set the stage for a bifurcation in how the tech names are trading.